Very good afternoon, learners. Welcome to today's session. I am Dr. Neha, working as an associate professor with School of Management Studies, Indira Gandhi National Open University. And today I am going to discuss another topic from the course Financial Management with you all. The topic for today will be capital budgeting. So before starting this topic, I would just want to start with the simple term called budgeting. What do we understand by this term, budgeting? We all do budgeting in our daily life. Sometimes it is budgeting for money, sometimes it is budgeting for time. So budgeting means planning in advance. Planning in advance very carefully that how we are going to spend our money on something. Okay, how we are going to spend our money on whatever we want to purchase. Suppose I am earning X amount in the beginning of month. Now how I am going to spend this amount in my day-to-day life. This is also something I have to plan well in advance, maybe in the beginning of month. Okay, this is called budgeting. Okay, the same concept is applicable for businesses as well. Businesses are earning profits, and how they are going to spend their profit, they have to plan well in advance. Okay, whether they want to purchase machinery, whether they want to keep some amount aside in the form of liquid cash, okay, or if they want to invest or start in a new project. These are all decisions which are taken by business well in advance. Now suppose I'm a businessman and I want to start a project. So I have to decide that how much amount I have to spend on a project. Now it depends upon that what return I am going to get from the project. So if the return that I am going to get from the project is more than what I have to invest in, then the project will be feasible for me. It is a profitable project, I should go for this. But if the condition is reverse, when my expenditure is more, but my expected return is less, in that case, I will reject the project. So we often need to make these kind of decisions when we are running a business. And these decisions are known as capital budgeting decisions. We also call them investment decisions. So today we are going to talk about these capital budgeting decisions. So coming to the formal definition of capital budgeting. So what do we understand by this term capital budgeting in terms of finance? So capital budgeting decisions may be defined as a firm's decision to invest. So firm needs to decide that they are ready to invest its current funds most efficiently. They need to choose such options where their funds are properly utilized. The funds are utilized most efficiently. And these funds needs to be invested in long-term assets. So basically, these capital budgeting decisions are long-term decisions. And this investment is made with the anticipation of an expected flow of benefits over a series of years. That means a one-time investment which is made now, okay, and this investment is expecting to give returns in future, okay, and that too for a longer duration of time. That means these are long-term decisions. So these are the decisions we need to take very carefully. These are thoughtful decisions that a company and a firm needs to take. These kind of decision also includes expansion, if the company decides to expand, acquisition, modernization of equipments, of technology, whatever. And it may be replacement of the long-term assets. Even if the company decides to modify or want to change their methods of sales distribution, maybe their advertisement campaigns, their R&D programs, they may also have long-term implications. So such decisions also falls under the category of capital budgeting decisions. And therefore, these capital budgeting decisions are also known as investment decisions. Coming to the features of capital budgeting or investment decisions. So these are the basic features of a capital budgeting decision. It involves exchange of current funds for future benefits. That means we have to pay now. We are investing the amount today, and we are expecting to get return in future. And future, that too for the longer duration. Funds are invested in long-term assets. That means the investment is long-term. So investment is not made just for a year or 2 years. The investment is made for, say, 10 years or 20 years. That is why these are called long-term decisions, because investment is made once and we are expecting returns in future. Now, if a company is purchasing a machinery, they are investing X amount now, but from that machinery, they are expecting return. They are expecting income in long term. The future benefits will occur to firm over number of years. Okay. So as I mentioned, that is why these decisions are called long-term decisions. Now, why these decisions are important? These are important because these decisions influence the firm's growth in long term. How the firm will work, how the firm will grow in future. It depends on right decisions. And capital budgeting decisions are most crucial one. It also affects the risk of the firm. It involves the commitment of large amount of funds. So investing in machinery, even investing in a sales distribution pattern, even changing advertisement campaign. These kind of decisions are not short-term decisions. It includes hefty amount by a company. A huge amount needs to be invested. So we need to be very, very careful when we are making these type of decisions. These are the decisions which are irreversible. Once we have made these decisions, it is very, very difficult or almost next to impossible to reverse these decisions. And even if we are able to reverse these decisions, a company will suffer substantial losses in this case. So again, I mentioned that we need to be careful. And that is why these kind of decisions are considered as most complex or most difficult decisions to make. So that is why these decisions are very important. Now, when we are making decision, there are thumb rules that we need to follow. And this rule in the case of investment decision can be that when we are making investment decision, this decision should be made such that it should maximize the shareholders' wealth. So basically, it should be in line with the primary objective of financial management. It should also consider all the cash flows to determine the true profitability of the project. So basically, it should include all the cash flows within the project. It should help ranking of the project according to their true profitability. So of course, it should be able to separate good projects and bad projects. But at the same time, if we have, say, 3 good projects, we should be able to rank that which is the best one and which is the next best and so on. So these kind of decisions should be helpful in making these decisions as well. It should help us to choose among mutually exclusive projects. That means if suppose we have 2 projects and we have to select one and we have to reject another. So we should be in condition to take such decisions. Okay, that which one amongst these 2 is best for us. Then it should be able to provide an objective and unambiguous way of separating good projects and bad projects, and also helpful in recognizing the fact that bigger cash flows are preferable to smaller ones. Okay, and early cash flows are preferable to later ones. So bigger the cash flow, it is better for us, and early the cash flow, it is again better for us. So these decisions should be helpful in taking decision considering all these points as well. So when we are taking these decisions, there are certain evaluation criteria that we need to take care of. And these are the evaluation criteria that we may consider while taking capital budgeting decision. The evaluation criteria are divided into 2 parts, that are non-discounting cash flow methods and as this discounting cash flows method. Non-discounting cash flow methods are those wherein we are not considering time value of money. This is something we have discussed in our previous sections, that there are certain methods which are not considering the time value of money. So under non-discounting method, we are going to discuss 2 methods, that is payback period method as well as accounting rate of return method. But under discounting cash flow method, we have 3 methods that we are going to discuss. This is net present value method and internal rate of return method. And the third one is profitability index method. So let us discuss these methods one by one. The first one is payback period method. So first we are discussing non-discounting methods. In today's session, we are going to discuss these two methods of non-discounting technique, that is payback period method and accounting rate of return. So first one is payback period method. So when I'm talking about payback period method, what do we understand by this term called payback? It itself says that whatever we are paying, how we are going to get it back and in what duration. So payback is nothing but it is the number of years which are required to recover the original cash outlay invested in a project. So basically whatever amount we have invested in a project, how long will it take to recover that amount? How long? That means that duration is our payback. So earlier it is, better it is for us. Okay, so payback period can be calculated mathematically with the help of this formula, wherein initial investment has to be divided by annual cash inflow. Okay. Then there is an acceptance rule in case of payback period. Now, if there is a standard project, how we can decide whether we should accept this project or not? So basically, in the beginning of year, as I mentioned, that businesses also plan. So they have some standard criteria, standard time period which they might have considered that they are expecting to get their investment back in say X or Y time period. Okay, so they must have maintained some standard in this. Okay, so if the payback period of that particular project is less than the maximum or the standard payback period, which is predefined by the management, then we are going to accept the project. Or if the situation is vice versa, that means if the payback period is more than the standard which is defined by the management in advance, in that case we are going to reject the project. Payback period can also be used for ranking the project. So in this case, how we can use it? While ranking the project, we will give first rank to the project with the least payback period. So it gives highest ranking to the project with the shortest payback period, and this is how we can rank the project. And then we have the third option as well, mutually exclusive projects. So how we can decide in this case? In this case, when the projects are mutually exclusive, we can accept the one with the shorter with the shorter payback period. So let us see that how this acceptance rule, how the concept of payback period can be applicable practically. So there may be two cases. Case one, when we have equal cash flows, we have made certain investment in beginning of the maybe accounting year, and we are expecting a fixed cash inflow after a particular period of time. That means the annual cash flow is fixed. So in this case, we can calculate payback period by dividing initial investment by annual cash inflow. Okay, in this case, we are not supposed to calculate average cash inflow because the average cash inflow will be equal to the amount that we are getting as annual cash inflow, because the cash flows are equal in this case. Let us see one practical example based on this. Now, if a machine has an initial investment of rupees 50 lakh, so this is the initial investment, and it generates an annual cash inflow of rupees 10 lakh for 5 years. Okay, what will be the payback period? Okay, so for 5 years, the company is getting 10 lakh rupees every year. Initial investment is 5 years. What should be the payback period we need to calculate? We'll simply place the values in our formula, wherein we have payback period which is equal to initial investment divided by our average or annual cash inflow in this case. So our initial investment is rupees 50 lakh in this case. This has to be divided by 10 lakh, and simply we will get this value which is 5 years. That means our payback period is 5 years in this case. Now suppose the standard which is predefined by the management is 4 years. Now if the standard is 4 years and we are recovering this amount in 5 years, in that case we are going to reject the project. But if the standard established by the company is let us suppose it's 7 years. They are expecting 7 years to recover this amount which is invested in the beginning. In this case, they are expecting to get the return in 7 years, but in this case of the project, the payback period is 5 years. So we are going to accept the project in this case. So this is how we can use this payback period method for the purpose of taking decisions. Now, what if the cash inflows are not equal? How we can calculate payback period, or how we can calculate this payback, how we can take decision when the cash inflows are not equal. For this also, the similar way is followed, but then there is a slight difference in the calculation. So in case of unequal cash flows, the payback period can be found by adding the cash inflows until the total is equal to initial cash outlay. Okay, so let us try and understand this case also with the help of one practical example. Now, there are uneven cash flows from a machinery. That means the company is getting uneven cash flows. The cash flows are not equal in this case. Now, how we are going to calculate payback period in this case? So in year 1, the company is getting 5 lakh as cash inflow. In second year, they are getting 7 lakh. In third year, 4 lakh. Fourth year also 4 lakh, and fifth year also 4 lakh. If the machinery's cost is rupees 10 lakh, that means cash outflow, the investment is rupees 10 lakh, then how long will it take to recover this amount? Okay, or the question may be reframed as what will be the payback period, or how much time will it take to recover this amount? That means 10 lakh rupees. So all we need to do it, we just need to place these cash inflows on a simple table. Okay, this first portion of the table is simply copied from the question, and I just need to calculate the cumulative value from this. So first I have to use this 5 lakh. Okay, in 5 lakh I am going to add this 7 lakh and I will get 12 lakh. But once I reach 12 lakh, I can see that at this level only I am recovering my cash outflow. Okay, my cash outflow was 10 lakh rupees. Okay, which is recovered somewhere here in between this. Okay, so my payback period is somewhere between 1 and 2 years. It is more than 1 year, but it is less than 2 years. Now, how can we calculate the exact payback using this? This can be calculated by using this method. So definitely our payback period is more than 1. So it should be 1 plus 10 lakh, which is our investment, minus 5 lakh. This is the amount of our previous year's cash inflow. Okay, 12 lakh, this is the cumulative amount for second year, minus 5 lakh, again the cash inflow of previous year. Okay, by solving this equation, I'll get 1 lakh, 1 year, that means first year, plus 5 lakh divided by 7 lakh, which will come to 1.71 years. Of course, we can finish our calculation here, but sometimes it may be possible, it is asked in the question that you need to give the proper payback period. So how we can convert this in months and days? So of course, it is more than first year, so our 1 will remain same as it is. Our 0.71, we need to multiply it with 12 because we have 12 months in a year, which will come around 8.52. So it includes 8 months. So from here we can take the time period as 8 months. We still left with this 0.52 figure. So now this 0.52 needs to be multiplied by 30 because after months we need to calculate days. Okay. So and on an average there are 30 days in a standard month. So by multiplying 0.52 by 30 we will get approximately 16 as a value, which is equal to 16 days. That is why I have written 16 days here. So that means our payback period, which is equal to 1.71. If I am going to convert this in years, months and days, I will get this value 1 year, 8 months and 16 days. So for this project, the recovery time period or the payback period is equal to 1 year, 8 months and 16 days. So this is how we can use payback period for taking decisions related to investments. Okay. Now, when we are evaluating this criteria, there are certain advantages and there are certain limitations also for using this method. This is very simple method. This is one of the advantage of using payback period. It covers the risk as well, and it is a clear indication of liquidity. It will tell you that where you are going to recover the investment, and post that whatever amount you are going to have, it's beyond your investment. So what will be your future liquidity? This can be calculated with the help of this method. But then there are certain serious limitations as well, that it ignores the cash flows after payback. So what after we have recovered our investments? We have recovered our investment, whatever amount we have invested. Now, how the future cash flows need to be utilized? When are we getting this? It may be possible that once you recover the amount, you are not not getting the return in future. Then what? So we are not able to answer such questions from this method. It also ignores the time value of money, which is again very important. The money value is changing every day, and this method is ignoring time value of money. So it is a serious limitation in this case. And of course, it ignores salvage value and life of the project as well. For how long? Suppose we have recovered our amount in 5 years, but the life of the project is say 20 years. So for next 15 years, this project is going to give us return. And at the end of its life also, they are going to give this project is going to give them salvage value to us. But we are ignoring these two things when it comes to payback period. So these are certain serious limitations of this method as well. Then we have one more method called accounting rate of return. As the name suggests, it talks about rate of return. Okay, so accounting rate of return is the ratio of average after tax profit, which is divided by average investment. That means they are talking about rate of return. What is our return and at what rate we are going to get the return? So our average investment needs to be divided by, average income needs to be divided by average investment. And by using this, we can calculate our average rate of return. If I have to formulate this equation, this formula in the form of equation, this is how this has to be represented. So EBIT, that means the profit, it has to be adjusted by tax. Okay, and this has to be divided by number of years for which we are getting the return, and we have to divide this with average investment that we are making. Okay, let us try and understand this concept of accounting rate of return with the help of practical example quickly. But before reaching to practical example, let us see its acceptance rule as well. So this method will accept all those projects whose ARR is higher than the minimum rate. Minimum rate is a rate which is established by the management. Okay, there is some standard value which is defined by the management. If we are getting the rate of return more than the standard, more than the predefined rate of the management, we are going to accept the project. But just in case we are not able to meet those standards, we are going to reject the project. And in case of mutually exclusive project, when we have to choose one, we are going to choose the one with the higher ARR. So the project which is having higher ARR will be accepted in case of mutually accepted project, but when we are comparing these two, the one with the lower ARR will be rejected. Let's see this practical example on this. So in this case, this is the case where a printer is purchased and the purchase price of printer is 22,000. Its salvage value is 2,000. Working capital amount, which is current assets minus current liabilities, is equal to 4,000, and the life of this printer is 5 years. They are using simple straight line method for depreciation calculation, and in this case the average income which is given from the printer is 32,000. That means average income is given, we need not calculate this. And the company's cutoff rate is 80%. Now this is the standard rate which is provided to us. We need to suggest whether the project is acceptable or not. So project will only be acceptable when the accounting rate of return is more than 80%. Average income is already given to us. All we need to calculate is average investment. So according to one formula that I dragged from accounting book, average investment can be calculated using this formula. So average investment can be equal to net working capital plus salvage value and average of initial cost of machinery minus salvage value. Okay, so by placing the values in this equation, I got this value. Our working capital is 4,000. Our salvage value, which is already given in the question, is 2,000. 22,000 minus 2,000, we have to take average of this, and by solving this equation I get this value of investment which is 16,000. Now I just need to place this value in my equation, in my formula of ARR, which is equal to average annual income divided by average investment. So average income, which is already given in the question, which is 32,000, average investment is 16,000, and to convert it into percentage term, I'm multiplying this with 100, and ARR in this case is 200%. The standard which is given by the management is 80%, and since we are able to earn 200% from this printer, we are going to accept this project, the project which includes this printer. So this is how we can use accounting rate of return for taking decisions, how the return is coming into it. So this is all for today's session. So in today's session, we have covered the basic definition of capital budgeting. We understood that what is capital budgeting, why capital budgeting decisions are important, what are the features of capital budgeting, what are discounting and non-discounting methods of capital budgeting, and today we have covered non-discounting methods, wherein we talked about payback period. Under payback period, we talked about the case where we have equal cash flows as well as unequal cash flows. And also we have seen one practical example of accounting rate of return. So this is what we have covered for today's session. So in future sessions, I'm going to cover the discounting methods of capital budgeting. So that is all from my side for the day. Thank you for patience hearing, and till the next session, happy learning.